It's my pleasure to present to you the 29th edition of the Capital Market Soundness report, themed Enhancing Capital Markets Liquidity through Transparency and Efficiency in OTC, or over-the-counter trade and trade reporting. We would want to first just explain the concept of OTC. And as this comes up, maybe we'll just go back a few steps on the capital markets. When you want to raise capital for the first time, you raise it through what we call a primary market. So that's where you have a debt issue, you have an equities issue. So the first time that capital is raised, that is called capital markets, primary markets. But after that, you would want to list the product into a secondary market. Now, the normal secondary market that you know is a stock exchange or a securities exchange. So there you're able to list. People are putting in their bids and offers. Orders match. There's a price. There's trading, there's settlement. Then there's exchange between the securities and the money. But there's another alternative segment in the secondary market where you can trade securities off exchange. So here, rather than matching that happens automatically, you have a set of players in this market that negotiate. So broker A will call dealer B, or dealer B will call dealer C. Then they say, I want to buy these shares at this price. Someone says, I want to sell. Then they negotiate, and once they're able to agree on a price, then that is reported in what is called a trade repository. You're not going through a formal securities exchange. A formal securities exchange is basically a centralized one. That comes with a set of rules, very, very detailed rules on how trade is going to be conducted, and uses especially brokers. So here, as I said, you just key in your offer bid. There could be several. You don't know even whose bid has matched with your offer. But now in an OTC market, you actually know who you're dealing with. Okay. Now, the situation with OTC markets, though they've really transformed over time, is that there are for companies that are not able to meet the requirements of the formal centralized exchange. So you'll get a small company, and they've raised capital, but they want to trade. The example I give sometimes is a land buying company. For example, their shares there, probably they're not meeting the eligibility criteria. Maybe they're not happy with the continuous reporting requirements in terms of cost to them. So they say, let me go off market. So those are used interchangeably, OTC, off market, off exchange. What happens in such a market is that it comprises of a network of dealers and brokers who negotiate bilaterally. So I'll give an example of if Safaricom was trading OTC, and nothing stops it from trading OTC. A company can delist and start trading OTC. A large company may also may find it appropriate to trade OTC, but in terms of prevalence, you get it the smaller companies that. So in that example of Safaricom, what happens with these dealers or broker dealers is that they provide a two-way quote. So dealer A will call dealer B and say, Safaricom offer 1,000 shares, 14 shillings buy, 15 shillings, sell. So in such a market where it's working properly, if anybody wants to buy Safaricom at 15 shillings and the dealer had offered to sell it at 15 shillings, they have an obligation to do so, and vice versa. So when you give a two-way price, you're obligated to make good if there's a matching bid. Fine. So that is how they make the market. Because first of all, we've said these companies don't meet the criteria for a centralized exchange, so they would necessarily be liquid. So you need someone to be able to push those prices. So there are people who are licensed and compensated for taking up that role of being a market maker. So when I talk of taking up a quote, a two-way quote, you're taking up the position of a market maker in the market.